This is the L2 Capital podcast with hedge fund manager Marcelo López. The L2 Capital podcast focuses on potential opportunities in the market and brings to your industry leaders and an intelligent conversation about their respective areas of expertise. And now, here's your host, Marcelo López.
Hello everyone and welcome to the L2 Capital podcast. I have the pleasure to talk today to another Brazilian, Otávio Costa, mostly known in the financial markets as Tavi Costa. Tavi is a portfolio manager at Crescat Capital and he's responsible for macro research. So Tavi, thank you for coming to this program. It's a pleasure to talk to you.
Hey, thanks Marcelo. It's a pleasure to talk to you as well and I look forward to this conversation.
So before we start talking about the macro picture, could you please tell us a little bit about yourself and Crescat Capital?
Absolutely. So I'm the portfolio manager now at Crescat Capital. I started work here about 6 years ago. We cover, more of this is a global macro hedge fund, and we develop macro themes through our systematic models, but it's very much of a discretionary strategy, if anything. And today, if we're going to look at the markets in general, our three high conviction themes are the U.S. being at the very late stages of the business cycle, gold being a very attractive asset to hold if there is such a downturn in the cycle, and the third one would be China and Hong Kong being perhaps one of the largest credit bubbles we've seen. But here at Crescat, we manage two portfolios or hedge funds, a global macro and a long short. We also have a large cap strategy, which is an SMA, and also now we just launched a new strategy that only focuses on mining stocks in gold and silver space. I was born and raised in Brazil and moved here to the U.S. to play tennis in college back about 10 years ago, and I moved here to Denver and now live here about 7 years or so.
Brilliant. Thank you for that. So you mentioned these three big themes that you're looking at the moment. Do you think we are in a major credit bubble now? Do you look at the amount of outstanding BBB bonds out there and think, if something happens, there's going to be a lot of trouble ahead?
Yes, we do. I think that more globally, though, I think the problems in terms of leverage are coming from places like China and Hong Kong and, perhaps Australia and Canada as well being part of that as more of a derivative of the issue. Now in the U.S., I personally believe that it's more a distortion of prices relative to fundamentals in general. And, several macro indicators are now pointing us to perhaps a turn in the cycle. In terms of the corporate debt market, yes, we do pay close attention to that. And now recently, especially on the leverage loan side, which reminds us a lot of those products in the housing market in 08 and 07 prior to the global financial crisis, with CLOs now packaging those leverage loans, and now you look at the prices of those bonds is starting to falter, and I think that divergence with junk bonds and the market overall looks quite interesting, especially as a bearish sign. But I think the distortion here in the U.S. is mostly due to asset prices in general being historically high relative or across almost every asset class you can think of here in the U.S. I think we're starting to have a transition now, especially on investor mindset of starting to really focus on more profitable projects and profitable investments in general. One good example of that was obviously the WeWork situation of now we have a ton of recent IPOs, having issues to perform well in this environment. I think that's all very telling of where we are in the cycle and how things are likely to play out in the near future.
Brilliant. So you believe we are at the end of the business cycle. And you also mentioned on Twitter Beyond Meat, Amazon, and Netflix. Are they the leading indicators in the U.S. stock market?
I think so. I think the FANG stocks, aside from Google, if you look at Netflix, now down close to 20% from its highs, and Amazon and Facebook doing quite the same thing, down close to 10 to 15%, depending on the stock. And Google is the only one that's still, near all-time highs. And when you look at NASDAQ, for instance, is definitely another separation there, which NASDAQ is very close to all-time all-time highs today. I believe it's about 1% or 2 percentage points away from that. But it's just I think the macro factors are really screaming perhaps a recession ahead here. I think the probability of that is really high. I mean, we have there's so many indicators. I'll give you one, for instance. We look at things like consumer confidence and unemployment rate. And when you look at that, those tend to be very reliable contrarian indicators. They most likely most of the times are very correlated to the changes in the business cycle. And if you create a ratio of that, just look at the consumer confidence provided by the Conference Board relative to unemployment rate. What you see there is that ratio is now retesting levels that happened during the tech bust and the 1970 recession. I think what it tells you is that perhaps consumer confidence have reached an extreme, and unemployment rate or the labor market can't really get stronger than what it is today. And we're starting to see some turns now. Job openings is starting to fall. When you look at that on a year-over-year basis relative to GDP, you can see that has also a very high correlation to GDP changes. And just in general, the deterioration in the S&P 500 now the percentage of members in the S&P 500 below 100 days moving average is now trending lower. And I think the major part of this whole bearish thesis is really on the yield curve inversions. Yield curve inversions, there's so many ways you can look at that. One way that we created here at Crescat was just looking at the percentage of yield curve inversions. And we reached close to 70% of the yield curve was inverted in the U.S. So we're looking across all yields, right? 30-year yields, 10-year yields, all the way to the Fed funds rate, which is overnight rate. When we look at those spreads, 44 possible spreads, and 70% of those were actually inverted last month. And I think that's also very telling, because every time you had that in history, you either coincided with the recession or actually preceded a recession, or were very close to a recession too. So I think this is not just just only problems. I think there are parts of the economy or assets that can do really well in an environment like this, like precious metals. But I do believe very strongly that the macro environment is certainly deteriorating significantly in the last few months and years, and I think we're getting close to an inflection point here.
Interesting. We're going to talk about precious metals soon, but just to stay on the theme for a little while, do you think negative rates are coming to the U.S.?
Personally, I'm not a fan of how people are saying that this is kind of a easy trade, that interest rates are going to go negative. And what we're seeing today actually is that interest rates are very low in the U.S. at the same time as now inflation is starting to pick up, especially core CPI and also median CPI. You can see both now being at a decade high, and that's and the other thing you can look at is also there's a Michigan University survey looking at outlook for rising prices now at a fresh 40-year low, which goes to show how the consumer and the households in general in the U.S. and investors are not really perceiving any type of risk in terms of inflation going forward. I don't necessarily share that thought. I actually think that there is a high probability of inflationary forces here picking up in recently. So I don't think it's an easy trade to just get long treasuries and go for the ride of going negative on yields. So in terms of 10 years and 30-year yields, I don't think that's perhaps it's not even close to my high conviction trade at all. In terms of the Fed funds rate, I think it's possible. I think that's the Fed reducing rates even more aggressively, as we've seen that monetary policy has become more and more aggressive over the years and across different business cycles since the 80s has been getting worse and worse, or more and more aggressive. So I think that part is quite possible. But on the 10-year and 30-year yields, it's not a bet that we're necessarily taking in a portfolio. The one bet in terms of rates that we're taking is more in a spread between German bonds and U.S. bonds or U.S. treasuries. So when you look at the 10-year yield differential between those two economies, those rates tend to converge when you get very close to the end of the business cycle. So I guess it's another way of also protecting your portfolio against perhaps a move in the business cycle here. It's actually a trade that has been working very well throughout the year, which is 10-year yields in the U.S. have been reducing, but also at the same time you've had recently, especially German bonds yields starting to move a little higher. So that convergence of the two rates is something I think it's a lot more attractive than being long treasuries on its own. The treasury part in our portfolio, we have a small position short U.S. treasuries, more directional in it, but that's nothing big. It's more because we think that inflationary risks are mispriced here today, given a lot of this the macro indicators showing that inflation could be picking up, and I don't think it could take a lot of people by surprise.
Interesting. Do you believe central banks can pump up liquidity and maintain this bubble for much longer? Do you try to time the market?
I think that's the $1 trillion question. I wish I knew the answer, and I think the best way to answer that question is really going back in history and look in seeing how that worked. The one instance we have here to look back is in 06 and 07 when similar macro indicators are also deteriorating at the time. What we had was that global central banks are printing money at the time significantly. I think it was somewhere close to $2 trillion prior to the first QE from the Fed. That never really prevented the business cycle from turning. I think what people are maybe confusing here is how I think, for instance, is that if there is liquidity from central banks, I don't think that liquidity will necessarily flow into risk-on assets, especially stocks, especially now at record valuations that we are today in so many fundamental factors you can look at. So, I think that's, liquidity can be pumped up, but I think liquidity will really flow towards things like precious metals. And so I think that's where the bet is in terms of the macro outlook, especially now with, I can't see a scenario in which, the growth in the U.S. here economically will pick up, and also, stocks, let's say stocks will rise here going forward in the next year or so. It's really difficult to see that happen without being pumped up by very extreme monetary policy, which would be positive for gold. So if anything here in this interview, I think that if there's one trade that I think it's going to work out very well in the following year or so is being long the gold to S&P 500 ratio. In other words, I think that gold is going to rise and I think stocks could fall. So I think that ratio is likely to double in the next 2 to 3 years.
Interesting. I have spoken to many people this year on this podcast, and pretty much all of them have recommended gold, or if you prefer, precious metals. Gold has gone up a bit this year, and you believe it's just the beginning of a multi-year bull market in precious metals, right?
I do. I think it's we had a run up in 2016, right after that final rate change in 2015, late 2015, and that caused a correction in the market. Gold prices began to rise, and then that only lasted until, I guess, August of 2016 on gold and silver stocks, and also the underlying physical gold and silver too. Since then we've had a sort of another part of a continuation of the bear market, especially for the stocks part of it. But I think that now we've I think Jim Grant put this very well in terms of how to look at gold. It's almost like a function of looking at one divided by faith in central banks, and I think that we've reached a peak of in terms of that faith, and I think that we're now about to see a change in that. If we put together just a lot of the indicators today in terms of the CPI being at a decade high, being record late in the business cycle, global debt being at historical levels, and the corporate debt problem that you just mentioned, central banks now easing, I think that whole scenario has to be somewhat positive for precious metals. So I think it's a good bet. I think a lot of mining stocks have been depressed since 2011, and there's a lot of value to be found in that space. So we've been focusing a lot on that, and I think we're in the very early stages of a bull market for the entire space, and it's going to be. I think there's a lot of opportunities still ahead.
Cool. Do you prefer gold over silver?
I don't look so much that way. I think I look more in terms of how to construct a portfolio in terms of risk. Obviously, silver is a lot more volatile than gold, so we have a larger position in gold and a smaller position in silver. Doesn't mean we liked one more than the other. I think we did prefer silver before just because of the positioning on CFTC, but today, we've had kind of a standard position in those two commodities. We've kind of added to a few precious metal stocks recently as a lot of them pulled back since that run up that you're talking about a few months ago. ago. And I think a lot of them look very interesting technically and fundamentally. We've had the luck to go to a few conferences to meet a few of those CEOs, and I think there's a lot of stories there that are quite attractive, and the whole bull case for gold and silver mining stocks looks very appealing.
Interesting. You're betting on gold and precious metals, but you're not bearish on the US dollar, are you?
No. So the bearishness of in terms of is more in terms of risk on assets in general, and I think that the problem here is that that's the issue with treasuries, that is so hard to take a position on treasuries, is because there is a deflationary force coming from China because of the currency. The currency devaluation does cause a very large deflationary force worldwide. So I think that's the biggest part that is hard to take a position. I think for instance, gold is rising for other reasons, more as a safe haven aspect of it, which is why we think it's so attractive. Now, answering your question, no, we're very bullish on the dollar, especially relative to the Chinese renminbi and the Hong Kong dollar, just because the Hong Kong dollar has a very low implied volatility to bet against. You don't have to take up a large position of your portfolio to put that position on. So that becomes more interesting. In terms of China, it's just looking at the credit bubble that we've seen build up in China with close to 400% normalized growth in banking assets. It's close to $40 trillion of balance sheet assets, not even counting the off balance sheet assets. And China, if you looked at this very indebted growth model, it can't afford a strong currency. So this entire thesis, going back to like the trade agreement between U.S. and China, that we're going to have a currency pact. I don't believe that that's even possible, just because China can't afford having a stronger currency. I think the non-performing loans problem is a bigger problem than a lot of people think, and dilution in the currency is likely to happen in a bigger way going forward. So if you put the part of the puzzle together, I think that the dollar could rise significantly versus the Chinese renminbi, and that takes other trades to start looking interesting. Some of the emerging market currencies that have performed really well throughout the year might also get hurt because of that, because they're very much derivatives of that China trade.
Interesting. So you're bearish on China. You mentioned this in the beginning. Can you tell us a little bit about it? What's your most likely scenario for China?
Yeah, I think that China has the slowdown growth, given that kind of a failing growth model of more debt and less GDP growth going forward is starting to show some real issues. Especially, let's just look at the home builders space. We've done a lot of work on that. It's a key part of this growth model in China. And if you looked at that whole industry, they have accumulated close to like $600 billion of net debt throughout since 08 or so, or actually it's outstanding today. But since 08, they actually lost close to $250 billion of cumulative losses in free cash flow. So it's significant. Those companies have been losing money for a long time. We've had housing prices in China rising significantly, Hong Kong doing the same, and now we're starting to see what we've been talking about for a long time, which is the capital outflows pressure. That the beginning of our thesis was really, in our calculation, a very large amount of illicit capital outflows that was pressuring the currency on the downside, and actually forcing the PBOC to be short the dollar, to really bet in the forward markets to continue to manipulate the peg where it is today. And I know it's kind of over a lot of people's head when you talk about that, but I truly believe that, for instance, a shrinking current account problem in China is a big deal. And if you looked back in history and you put out a chart looking at several other countries that had that situation of shrinking current account, that tends to be very negative for their currency. You can look at, for instance, Argentina being one of the outliers, losing close to 5% of the current account since 08, and at the same time its currency value lost close to 90% of its value. I know that that's an extreme, but that's kind of the scenario that usually you see. And the countries that have not had a devaluation of the currency while their current account has been performing very poorly is Hong Kong, China, and Saudi Arabia. All those countries have pegged currencies. At some point, those imbalances begin to matter. And I think China is starting to show some problems in terms of that. The way that we see how it's going to play out is especially and again bringing back gold to the whole idea. When you look at gold itself, yes, gold has not been performing well for the last years or so, but gold has done very well against currencies that have the value or emerging markets that have had issues before. Like let's say gold in Brazilian real, or gold in Turkish lira, or gold in Argentinian peso or Venezuelan peso. There's so many examples of how gold has done really well in local currency terms, and that's how it's supposed to do during those periods. We think that in China, gold in renminbi terms is likely to rise as ultimately the way to play this trade.
Interesting what you mentioned just at the end. Simon Mikhailovich also came to this podcast and he said something around along those lines. Gold is an insurance when you need insurance, so it's doing its job when it's needed.
And if I can add something interesting on the Hong Kong protests, which I think it's very much in line with this. You're from Brazil, you know how political crises unfold, and usually, you see some sort of either a recession or a currency crisis. I think those things kind of tend to work together. Now, in Hong Kong, in terms of the protests, there's kind of a key difference between protests in general. You have those protests that sometimes are very political, some others are more economic driven, and sometimes they can overlap too. Now, in Brazil, for instance, in 2014 or so, when we had those protests that took Dilma out and impeached the president, I think that, if you really look at the bulk of the problem, people are just fed up with the economic conditions in general. Unemployment was rising, inflation was rising, the dollar was rising, and, that caused people to really go after and create social unrest and look for a political change. I thought that initially the Hong Kong protest was a lot more, related to the democracy move. But now the more I research more about it, what I understand here is that, sure, there is a move towards that. But what's really here that is a lot more important and which makes this protest a lot more serious than other protests is when it's driven by economic issues. And I think that that's very much what this is about, is people are fed up with their the standards of living in Hong Kong, house prices and low wages and so forth. And I think that that's really what's driving, because if it's not that, it's hard for something to be sustainable, because what causes you is that people start getting hurt as they protest more. Either their jobs start doing more poorly or their businesses start doing more poorly. So they end up giving up on the situation. Now, when the economic situation is already bad, it kind of gives you no reason for why not. Am I not going to, create a social unrest here? So it's, I think that that's very much what's happening in Hong Kong is definitely that. It's, and why I think it's so critical to this whole China and Hong Kong credit bubble situation.
Great. Interesting. So Tavi, the three big themes that you and Crescat are investing now seem very compelling. What signs do you have to see to change your mind? In other words, what would make you change your mind about China and the precious metals sector?
I think there's a lot that would have to change. I haven't seen much of the macro indicators in China in general moving, accelerating again. So, in terms of, let's just say the U.S., for instance, the distortions between prices and fundamentals, in order for you to change that, you would have to see a significant improvement in fundamentals that would make those risk on assets cheaper again, or, make those investments look more compelling, which is not the case. And it's kind of hard to see it. So you would be calling for a soft landing scenario that is very unlikely, at least historically, especially when you reach levels that we've reached. So I think that would be one thing, would be the improvement of the fundamentals of companies in general. Companies would have to be earning even more, which I think they're already peaked earnings and margins and still when you look at that relative to prices, it's just absurd. So that would have to be improved improve significantly if that's the case, and prices would have to be where they are today. So those ratios, multiples would get much cheaper. In terms of China, I mean, we haven't seen anything. I mean, the one thing we hear a lot is that China is going to kind of transition from this export-led economy to a consumer-led economy, and it's not really what's happening at all. You look at the sales of vehicles and retail sales in general in China, they're at multi-year lows. Nothing is picking up in terms of that. Credit growth is not picking up at all right now. I think that those are all very, very important parts of the Chinese economy. And now the other thing that could happen that could help China would be a shift here in terms of becoming more of a socialist economy here in the U.S. That today a lot of the socialist parties in the U.S. have been taking the side of against China in a lot of the issues, especially in Hong Kong protests. But I think that could change very much if they take power, because they know that having such a hawkish stance wouldn't go very much in line with providing growth for the U.S. So they would probably be forced to move the other way. So I hope I'm answering your question, but I think that those are the major parts. And I think the third part is we're going to, for the gold to not work and for me to change my view, would really see, a deflationary signs all over. Again, things that we've had, in the last two business cycles, we kind of had. That's why treasuries worked out so great during those two changes in the business cycle. And gold did really well in the tech bust, but not so well, at least in some parts of the 08, especially 1 or 2 months during that period. Now I think politically and in terms of monetary policy, things are just going to get more extreme as we go. And I think all those central banks are really in a corner now. I think that there's it's kind of difficult to see a scenario in which a risk on assets will start doing really well without the very strong intervention of those parties. So I hope I answer your question, but I think those would be things I would be paying attention to change my view.
Brilliant. Thanks for that. Tavi, once again, many thanks for coming to this program and sharing your views with us. It was a pleasure to talk to you, and let's see if we can meet up in São Paulo anytime soon and go for a beer and a chat.
Absolutely. It was a pleasure talking to you, Marcelo. And yeah, I would love to do that. Get a caipirinha in Brazil.
Brilliant. Thanks, Tavi. I'll talk to you soon.
Thank you.
If you like this podcast, feel free to forward it to your friends and colleagues. We appreciate your time, support, and your feedback. You can follow Marcelo López on Twitter at MALopez1975. The information presented here is not investment advice and should not be taken as such. You should do your own due diligence and consult with your financial advisor before doing anything suggested or mentioned in this podcast. L2 Capital and its partners will not be liable for any losses that occur in doing whatever is discussed in this podcast.